Good day to all. Today I'm going to discuss about audit of the sales and collection cycle, which is one of our transaction cycles in accounting, tests of control, and substantive tests of transactions. Just a little bit of review, though, that when we say sales and collection cycle, of course, we're talking about two major transactions here. We have the sales, either in cash and on account or credit, and of course the collection of the credit sales if we talk about such. Then test of control will be the testing of internal controls present or existing in a client or business. And then the substantive test of transactions would be the very specific testing or looking into the details of transactions, which can be either on totals or the details, as well as analytical procedures as a review of auditing theory. So to continue for this particular discussions, number one is we have to identify the accounts or account titles which are affected here and the classes of transactions in the sales and collection cycle. So in this illustration, we can see here in figure 14-1, which is all about accounts in the sales and collection cycle, wherein we can see the specific accounts affected. We have sales, accounts receivable, cash in bank. Of course, those are very common terms that we have known thus far in this particular level in accounting. Then allowance for uncollectible accounts, which would be the portion estimated that we cannot collect from the accounts receivable, cash discounts taken, and then cash discounts would be the discounts that are obtained upon collection. Then sales returns and allowances. So here are the actual returns of goods coming from the customers and the expense portion of the provision of our uncollectible accounts. So normally these are the accounts that are affected, and of course they will have connection with the subsequent topics, just like with this second function or second objective. Then we can also see here the specific transactions or classes of transactions that do affect each account. So example, for cash sales, that would go to cash in bank. Sales on account, of course, will have impact on credit of sales and debit on sales of account for accounts receivable. Then for the AR or accounts receivable T account, beginning balance, then ending balance, sales on account as discussed, cash receipts or the collections, which would also form part of cash in bank. And then cash receipts, of course, will have also impact on the cash discounts as taken. So remember, if the customer would avail of the discount, so receipts would be lower or lesser. Then returns and allowances will also be serving as reduction of accounts receivable as well as the write-off of uncollectible accounts. It's just a review anyway for our accounting subjects. Then allowance for uncollectible accounts will be affected by the bad debt expense as debited provision, then credit write-off. If there would be recovery, that would be a plus also for the allowance for uncollectible accounts, but then for accounts receivable, it will be offsetting in effect. Okay, so second would be the business functions and the related documents and records in a sales and collection cycle. We have to describe them. For these slides here, we will see three columns: accounts, business functions, and the documents and records. So for accounts, we have here the sales and accounts receivable. Then the functions of business that they're connected or related would be, example would be the processing of customer orders. So if these orders have been granted by the credit department, of course, we have to segregate incompatible tasks, duties, and responsibilities. Then shipping goods, we have to ship the goods after granting such credit. And upon, or for example, we have already done with the delivery of the goods as received or recognized by our customers. Later on, we have to bill our customers for such values of goods or accounts. And then we now have to record accounts receivable and sales. What are the documents and records that would be affected? Of course, we have for the order, customer order, and then sales order, or either. Then we have shipping document, we have sales invoice. If really the customer accepted already the said delivery of goods. And then we also have the sales transaction file, sales journal or listing, the AR master file, the trial balance, and the monthly financial statement. So we can see here that this begins from order, then to the shipping of the goods, upon, of course, or when we are already done with the granting of the credit. And then sales invoice is to be made. Then later on, that will be recorded in our journal and would go to our general ledger files and to our financial statements. All right. What about for the receipts, cash receipts transaction? Here we can see that the affected would be the cash in bank, debits from cash receipts, and then the accounts receivable. Business functions would be the processing and recording of cash receipts. What would be the documents and records that would be affected? So we have here the remittance advice coming from our customer that it already forwarded certain collections or certain payments, of course, it's coming from the customers of such accounts receivable. Then pre-listing of cash receipts, because you still have to screen if the amount really is belonging to that account. Then cash receipts transaction file upon confirmation of such collections. And then we also have the cash receipts journal or listing. So this would be the records that we will have there on our general ledger file or as appropriate. Then after that, this is for sales returns and allowances transaction. The affected accounts, as said, would be debit to sales returns and allowances and accounts receivable. Business functions would be the processing of that. And then the documents and records that would be involved will be credit memo and then the journal for such. After this would be the write-off of uncollectible accounts transaction. For this, the affected would be the allowance for uncollectible accounts that would be a debit because it will be a minus. Then accounts receivable would be credit that would also be a minus. Then this is the function and the documents and records that will be involved will be the authorization form for such uncollectible accounts and the general journal because this will be recorded there. After bad debt expense transaction, the accounts affected would be the bad debt expense to be debited and then credit for the allowance. This would be the transaction for bad debts and we have to record such in the general journal. For processing of customer orders, we have to remember that customer order is a request from a customer, and then the sales order, on the other hand, would describe the goods ordered by a customer. So in this case, we can see the difference, although we might think that they are the same. They relate though to the orders, but customer order will be from the request of a customer and sales order would be the details. Then granting of credit should be separate from other functions like recording, custody, and then of course, authorization should be separate from other functions. Authorization for granting of credit. Before goods are shipped, you have to make sure that the approval must be made or was made by a properly authorized person to the customer for sales and account. In shipping of goods, this is the point in which the cycle at which the company gives up assets. So later on, if we really deliver the goods and the customer received such in good condition with no complaints whatsoever, so in that case, then really an asset is given up and to be recorded appropriately. Then the evidence of this shipping is called the bill of lading. wherein this is often transmitted once goods have been shipped. So here's a flow for billing of customers and recording of sales. We have to bill to, this is the billing statement. Then we'll go to our sales transaction file, and then that would be the basis for the sales journal. For the sales journal, of course, the recording of the sales, which will go also to the AR file and the accounts receivable general ledger before going to the trial balance and the financial statements. You can recall we already discussed this part actually. Then the processing and recording of cash receipts, the money will be recorded in the pre-listing of cash receipts. So simple lists of cash receipts made could be daily and then with the customer details. Then we'll go later on to the cash receipts transaction file, and then will be part of our reports. For the sales returns and allowances, we have the credit memo and the journal. Credit memo as opposed to debit memo, because debit memo is for purchase returns and allowances. Then for writing off of uncollectible accounts receivable, we have already mentioned about this particular form, the authorization form, which indicates the authority to write off a certain account as uncollectible. So it is not actually automatic to write off an accounts receivable which is deemed uncollectible. It must be that there is a basis for that. And what could be the basis? Based on experience, it has been determined, for example, that this is what we cannot collect. If that is based on experience or trend or pattern, then that is an estimate, which is the expense. On the other hand, if we're talking about the write-off, this is actually what has been determined from certain sources, for example, out of examining, let's say, a company that can no longer pay because it faces, for example, bankruptcy or any other financial difficulties and so on. And so that would be the basis and explanation, and then the authorization should be done by a person of authority. Then providing for bad debts, as I explained, which is the expense. Then this is based on experience, trend, pattern, and so on. This is residual resulting from management's end of period adjustment of the allowance for uncollectible accounts. This becomes residual if, for example, we are using the IFRS methods, which are aging of accounts receivable and provision of accounts receivable, because remember, whatever is obtained there will be the ending balance of the allowance for uncollectible accounts, and the expense will have to be squeezed. So that's why I said the bad debts would be residual. However, if we are using the third, or we are using the third method, which is percentage of sales, remember that is the expense, which is US GAAP based. We are now focused on number one, the aging based on the hierarchy or order of priority. Next would be the percentage of receivables, and third would be percentage of sales. Number one is also known as matrix method. So you can refer to your discussions in your financial accounting and reporting subjects or courses. Number three is that we have to understand internal control and design and perform tests of controls and substantive tests of transactions for sales. So for the methodology for designing controls and substantive tests, so here are certain items that we have to take note or take into account. We have here the flow. So we have to understand internal control of sales. Internal control, as explained or defined by COSO, is a set of policies, procedures, processes, steps, guidelines, frameworks that are intended to achieve four objectives. In fact, for COSO, they have three, but then some books will be adding one. Number one is fairness and reliability of financial reporting. Second is effectiveness and efficiency of operations. Third is compliance with applicable laws and regulations. And four is safeguarding of assets. So those are the four objectives or purposes of internal control. And then we have to check if they are there, and we have to understand how sales are being protected or, of course, being processed. Then we have to assess the planned control risk of sales. So based on the internal controls present, and then we have to quantify if we would like to have easier computations then, or to make our lives easier. So what would be our control risk assessment based on the internal controls? Control risk is the risk that the internal controls present of a business or a client cannot detect material misstatements. Then we have to determine the extent of testing of controls. So like how are we going to test controls? Will it be very exhaustive, very extensive, or less extensive? So it depends upon the level of the control risk. Then we are going to design the tests of controls and substantive tests of transactions for sale in order to meet the transaction related objectives. So we will have to review later on the so-called management assertions or representations. And therefore, we will now be planning our audit procedures, the size of our sample, the items to select, and the timing. So we have to understand internal control sales. Then we can study the client's flow charts, prepare an internal control questionnaire, and walk through tests of sales. So this is to document, or this is to record our understanding of internal controls present based on sales, of course, sales and collection cycle of our customers. Then for the planned control risk, these are the 4 steps. Framework for assessment, then identify the key internal controls and deficiencies, associate these controls and deficiencies. So if there are deficiencies, how do we, or how did the company or business or client be able to respond to such deficiencies? Then with the objectives of our audit, then assess control risk for each objective. So it's a matter of, before we proceed, it's a matter of aligning the controls, deficiencies, and the objectives and the control risk. Then here are some areas by which we can assess the planned control risk based on sales. So adequate separation of duties is a must. That's what I've said here. These are the 4 incompatible tasks, duties, and responsibilities that are normally being identified. So care, custody, authorization, recording, and execution. Well, for some books, I understand that there is only like 3, and that is car, custody, authorization, and recording, no execution. But majority of the books are saying that there are 4. Anyway, to differentiate, just a review or recap, custody, of course, is of having the possession of goods, not literally. So you're in charge of keeping and safeguarding of such assets. If you say authorization, then one is having the authority to approve or disapprove, accept or reject certain transaction. Then R is recording. So this is now the accounting aspect of journalizing of transactions based on certain source documents. And E would be execution. So based on the authorization given, for example, the authorization is to purchase goods or to sell or ship the goods. So the execution will be the one responsible to do such transaction. So those are the 4 duties which are incompatible and should be separated. Otherwise, if we combine, it would be easier for employees or staff or personnel to commit fraud. Then there should be proper authorization, documents and records should be adequate. Then the documents are pre-numbered. This one I would like to highlight. This is really something that is connected or closely connected with completeness assertion, because it is easier to check if certain transactions that have existed are completely recorded if they are pre-numbered. We can just trace the series then. Then the monthly statements are available so that we can verify, for example, based on the listing and then based on the records. And then internal verification procedures are present. If something is happening, so we can verify. Then the extent of testing of controls, if you can notice, here is a weighing scale. And then on the left side, we can see the control risk. And on the right side, control effectiveness. You can notice that when the control risk is lower, so the control effectiveness in that case is something that is lighter. Or we can also interpret this one as that if control risk is higher, so the effectiveness of that control or certain internal control is lower. So there is a reverse relationship between or inverse relationship between the control risk and control effectiveness. Next, for the directions of tests for sales, we have to remember this particular flow that we begin from the order of the customer before the goods are shipped to the intended customer, and then sales invoice are to be duplicated because there would be original sales invoices which will be given to certain buyers or customers, and then duplicate will be kept. Although in computerized world, everyone can get the original, everybody happy. Then sales journal from there based on the invoice that is kept. That's the basis. So there would be AR and sales, and then we'll go to the general ledger, to the master file, and to the financial statements. We have to remember these management assertions that if our flow is from source documents to our records, you can notice here this particular circle with the arrow. So that's from source documents to our records, and we call this completeness. So we are checking here if the transactions that occurred or existed really are recorded in the sales journal. So we would be asking, are the transactions completely recorded? And then we call this tracing. On another hand, if our flow is from the records to the source documents, you would like to check if, for example, those transactions that have been recorded really existed or occurred. So we are now vouching, we are now checking the veracity, or we are checking the authenticity or genuineness of a certain transaction. So this is the very important thing. I repeat, completeness is to tracing, while occurrence or existence is to vouching. And these are the normally first two management assertions that are to be made known of by auditors or learners. So please take note of such. In addition, we have to take note that completeness assertion is very concerned about the transactions if they have been completely recorded. So this would be geared towards possible understatement. On another hand, occurrence is concerned as to whether there are certain non-existent or fictitious sales transactions. And that's why this is geared towards overstatement of sales. In addition, these are the transaction-related audit objectives, which would be occurrence or existence. As explained a while ago, we'll check whether certain recorded sales are actually made, or the shipments have been made, or they actually occurred. Then completeness would be to check if those transactions confirmed to be existing have been recorded. Accuracy will be for the amounts or values as recorded for such sales. On another hand, posting and summarization would be to check if whether the sales transactions have been correctly included or posted or transferred or reflected in the master file. Classification will be if sales transactions are correctly classified into credit or cash, or if there are more sales like installment sales and consignment sales, so they have also to be reflected. Then timing, if they have been recorded on the correct dates, because if they have been reflected on the dates which are correct, so such will be reflected also on the correct financial statements or reports. So based on the date, for example, if the sale is by March and then that has been recorded in April, so the March sales would be understated, April would be overstated. So there would be impacts on the respective reports, either as overstatement or understatement. Then For the COSO report, COSO, by the way, means the Committee of Sponsoring Organizations of the Tradeway Commission, that is geared towards internal control that should be present in the organizations that have to be effective and efficient. So based on the report issued by COSO, these are the common revenue misstatement techniques that are being made. Example would be sham sales, meaning fictitious sales, or fraudulent cooking or adding or increasing of sales. Next would be improper percentage of completion. If you're talking about construction contracts, which are based on percentages of completion, so if the percentage has been incorrectly or improperly calculated, so that would have impact on the revenue. Conditional sales, since there are sales which are subject to condition, and then if that is still not satisfied, so of course the sale would not be reflected yet as revenue. Then round shipping loans as sales, there are certain loans that are being made and are reflected as sales, which is quite ironic because loans are liabilities and sales are revenues. Consignment sales has been mentioned, but then basically this is when a certain seller would be the principal and will be delivering goods. That party will be called consignor, and such goods will be delivered to the consignee or the agent, and the latter would be getting commissions out of the sales of the goods delivered and will be remitting the net proceeds less reimbursable expenses in such contract. Then bill and hold. So you are selling the goods, but then you're keeping such for the meantime. There will be different rules for that. Unauthorized shipments. Shipments are being made without authorization, of course. And then premature revenue recognition. Supposedly, the revenue should not be recognized, but it has been made, and sales cut off. It's possible this is a case of window dressing. So to make the financial statements appealable, so certain sales from next year or of next year will be considered as part or will be placed as part of the current year's sales so that sales would increase. So these are the common revenue misstatement techniques as identified by COSO. Then for methodology of sales as summarized, we have to identify the key transaction-related audit objectives. As explained, occurrence or existence. We have completeness. We have posting and summarization. We also have more of such timing, cutoff, and etc. Then determine the key existing controls. Design the controls as of course to be tested, so the test of controls to verify effectiveness of such, evaluate the control deficiencies and the extent of substantive tests to be made, whether it's going to be more extensive or less extensive. After that, what about for apply the methodology for controls over sales transactions, the controls over sales returns and allowances. So in other words, whatever has been discussed will be applied also to SR and A. The transaction-related audit objectives and the client's methods of controlling misstatements are essentially the same for processing these credit memos, which would result to SR&A and as of that of sales. However, there are two differences based on materiality, which is a combination of quantitative and qualitative factors, so both in numbers and in words, and emphasis on objectives. So those are the two differences. Because if we are going to take note, guys, for materiality, if we compare the returns and allowances versus the sales, of course, the sales returns and allowances would be much smaller compared to the total amount or value of sales. And then for the objectives, so there would be differences though, because now we are looking into the deductions of the sales and the goods which are actually returned. For the fifth one, we have to understand internal control. And then, as said, can be documented in a form of flowchart, or we can have narrative way of doing that, or paragraph form. Design and perform tests of controls and substantive tests of transactions for cash receipts. So we have the collections now. In this case, for the TOC and the STT, so when I say TOC, I mean test of controls, and STT, substantive test of transactions. We have to determine whether cash received was recorded. So any receipt is recorded. Then we have to prepare the proof of cash receipts. This is like a to-date bank reconciliation. So just to check if ever we are balanced at the end of two dates or months, for example. And then lapping of accounts receivable, because it's possible that collections of one account will be applied to other accounts, hence lapping, or that is covering certain accounts collections with other accounts collections. Next would be, what about for write-offs in terms of controls? So for audit tests, we can do the occurrence, whether there has been really a write-off. We can check that one. Then the authorization and the verification, whether the values are correct, or just to check if that is authentic or what. Then effect of results of controls and substantive tests of transactions. As a review, these are again the four most common accounts affected by the testing. We have the accounts receivable, we have cash, allowance for doubtful accounts, and bad debt expense. Although for overall, remember there's also sales. Then these are the types of audit tests that we can do for sales and collection cycle. For sales, so remember the sales transactions will be connected, of course, to the account. Again, will be connected to accounts receivable for these transactions. And then we can audit by test of controls for the internal controls present. And then STOT means substantive tests of transactions based on the transaction related audit objectives like occurrence or existence, completeness, etc. Then AP stands for analytical procedures, wherein we can make use of our ratios. So if you can recall on financial statement analysis, just to be able to check if really the percentages are healthy. So how do we do that? Normally, we compare such with certain industry or industries to which a certain company or companies would be belonging to. So we have to check, for example, if the percentage of AR or accounts receivable is, so again, ratios for analytical procedures. Then same for cash receipts transactions that would affect accounts receivable and cash in bank. Then for the ending balances of the accounts, like sales and accounts receivable, we can audit by analytical procedures like ratios, AR over sales here, ending balances, then what percentage of AR or the credit sales that would be part or the portion of AR or credit sales to the total sales of the company and to the industry to which it belongs to. TDB, on another hand, means the tests of details of balances. And if we do these certain tests, TOC, STOT, AP, and TDB, this would now comprise to sufficient appropriate evidence. So the evidence that we would be gathering would be deemed sufficient. So in terms of quantity, it would be effective and efficient, and appropriate means or talks about the quality of the evidence, right? So this ends our discussion involving the substantive test of transactions and test of controls, or vice versa, for sales and collection cycle. Thank you very much for listening, and God bless.